Welcome, everybody, to the Chinchilla Pickin' Podcast. It is June the 9th, 2024, 4:24 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood. I'm joined by the one and only, the Baron of Bonds, Brandon Sadface Beaver, because he didn't get the countdown this time. So,
Yeah, I didn't get the countdown, and my Mavs lost game one, but we got game two tonight at 8 o'clock, so we'll see what happens.
I know I trolled you on Facebook about it, and I got harassed back.
Yeah.
I guess that's what I get for trying to be funny. Oh,
But
man.
she was mostly just messing with you, too, so she wanted me to tell you that she was just kidding also.
It's good.
But
It's good. It's all good.
Huge girlfriend is a huge Mavs fan. You might as well just section off my house here in my little corner of Trenton, Ohio, and rezone it for the city of Dallas, because we're Cowboys and Mavs fans here.
But are you Stars fans for
I
hockey?
don't know. I don't even know who they are.
The Dallas Stars, the NHL hockey team that was in the playoffs?
The only thing I know about hockey is it looks like Salt Lake City's getting a team. I heard about that on ESPN, but no.
I'm surprised I don't already have one.
I don't watch any hockey.
All right, so I want to get a little bit of
there's baseball, Dave, on in the other room right now because I'm an American.
Nice. I do. So I will say this: I watch weird sports. Besides UFC and boxing, those are probably the most mainstream sports, and college football. I watch my Huskers lose every season. But besides that, I mean, I watched like rowing, fencing, really weird, off the beat, like Olympic type sports is what I'll watch.
Country club sports.
Yeah, that's kind of like my thing.
Right.
That's what I enjoy. I really do the UFC and boxing just because I have a history in there, and my daughter is big into it. She pedals around with it as well. So I mean, we have an interest there, but and then Nebraska football because I moved around. If you're listening right now, I have moved around all my life. I lived up until about 11, 12 overseas in Europe, different parts of Europe. So I learned to read and write European style. There actually is a way to write European style, by the way. But it came back to the United States, and I finished high school in Omaha, Nebraska, went to college in Texas, moved out to California for a little bit. So I've been all around. But my high school in Nebraska really set in the fact that I wanted to be a Husker fan. Because at that time, Huskers were just killing everybody. So I've traveled around everywhere and got this big experience, but that's why I became a Husker fan. So, meanwhile, my time at college in Texas, since we're going to talk about Texas, that's my hard transition, if you will. Texas is going out here and trying to create their own stock exchange to compete with New York. Brandon, I know you wanted to bring this up, so I know we're just still doing like a 1 to 2 minute on this, but go ahead. Quick thoughts.
So this has happened before. There's been a Chicago Stock Exchange, a Boston Stock Exchange. They've all been swallowed up by the NASDAQ or the NYSE or whoever. We essentially have a duopoly right now. We do have other exchanges in the United States, but they got about 3 to 4% market share. So my thing is that I'm all about more competition. I'm happy about that if other companies want to go to Texas. We've got a situation right now where companies are wanting to incorporate in Texas because of the tax advantages. That may help out this new exchange. I don't know. Traders aren't really going to notice much about this anyways because regulations say that all of these exchanges have to link together no matter what. So you're going to have your brokerage account. If there's going to be any stocks that are only listed on this new Texas exchange, you're going to have access to them regardless. So that's good. Now, whether or not, the big question is whether or not companies are going to want to IPO on this new exchange rather than going to the New York Stock Exchange, or to the NASDAQ. The long enjoyed duopoly by New York Stock Exchange and by the NASDAQ, they've kind of taken advantage of that. They've put a lot of regulations on companies that they didn't really care if these companies liked it or not, because where else were you going to go? But now with a third option, maybe there's going to be some competition there. I know a lot of CEOs want to ring that bell on the Nasdaq or the NYSE just because the historical importance of that. But some companies may decide, hey, let's go to Texas. I mean, Dallas has been a heavy area for the stock trading industry for years now. So maybe we got a new contender.
Yeah, yeah, and there's been a lot of firms out of Houston with all the oil companies located out of Houston as well. So I mean, there is a big center there, and I like you. I'm for competition, so
Right.
I'm for it in that regard. Let's do it. Let's go forward. It's not going to affect how we trade. Yeah, I'm all for it.
Now the big question is will the IPOs be successful, right? And who's going to want to take that first step into taking the risk that this new exchange is going to handle the IPO appropriately?
Tesla.
Because those IPOs are very, very, very important. You think Tesla will do it, but they're already listed though.
I know they'll
So
just
maybe they
remove
get rid,
themselves from that list and join this other one.
or X if X goes public again.
Yep. I mean, I could list CEOs that are most likely because the headquarters are already located in Texas.
Right. Right. Well, I think Tesla is still headquartered in Delaware. I think he just wants to
I
change it.
it's funny because I laugh because when in my early 20s I had I created an LLC located in Delaware, and there's a reason why we all choose Delaware.
Yeah. Well, the
It's
thing is that it came back to kind of bite him because this recent pay package was just voted down by Delaware. So the state of
yeah.
Delaware says that he can't get the pay package he wants. So he's not happy about that.
Yeah. So if you don't know, you're listening. We're going to get in the show here in a minute. But if you don't know, Delaware, if you LLC in Delaware, there's no corporate income tax. It's funny because of who comes from Delaware and who controls Delaware that they don't have a corporate income tax, and that you get all these other loopholes and tax loopholes by incorporating in Delaware. So
Is that the guy that took the train to Delaware every day or whatever? I know you're talking about.
the guy from
Uh,
Scranton, Pennsylvania,
yeah.
likes ice
Okay.
cream.
Right.
Okay. All right, rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You get the live back and forth, the bicker and the banter right here on the show for you. All right, Brandon. I know you like to start off, and you mentioned what you have. Go into it, and I know we cross cover one topic, but I'll let you start.
Yeah.
Go ahead, man.
All right. So I've talked about Lockheed Martin a lot on the show. It's been one of the underperformers. It's done well. It's done okay. It's about 9%. If you look at the last 5 years, 9% return for investors. But that's underperforming the S&P 500. However, earnings for Lockheed Martin have been about 3 times greater than the average S&P 500 company. So we're kind of overlooking some things here. I think with the price to earnings ratio as low as 17% right now for Lockheed Martin, I think that's we're a little bit below fair value here. I think this is a good buy. They've had some supply chain issues that have limited production since COVID. Who hasn't? That's starting to clear up, but we've had concerns about military spending. For example, this budget, the military budget for this year, only up 1%. So that hasn't fared well for the defense industry stocks. But we've got order backlogs that are growing. Manufacturing seems to be improving in this industry at least. And we do have expected increases in spending. We've also got capital returns that have been pretty good for this company. We've got share buybacks. We've got dividends. These are all things I think that should boost Lockheed shares in the years to come. If you're looking at returning to value, I think Lockheed Martin with a 2 to 3 outlook here as supply chain issues start to go away. I think it's something that should be in your portfolio. We've got about $120 billion from previous budgets that'll be added over the next 3 to 4 years from U.S. military spending that I think a lot of experts are overlooking here. So yeah, only a 1% in the military budget, but growth year over year, that is. But with $120 billion from previous budgets that are unused, that's set to go into effect in the next 3 to 4 years, I think Lockheed Martin is going to be a big beneficiary of that money. So we're going to have some decent top line and free cash flow growth, I think, up ahead. Uh, like I said, earnings per share, they've nearly tripled over the past decade. Despite the outperformance, the stock trades at about a 15% discount to the S&P 500 based on the last 12 months. Uh, Analyst sentiment is low here, which is fine with me. I'm famous for, I think, well, not famous. I don't think I'm famous, but, I'm, it's
I think you're famous.
Oh, thanks. I appreciate it. It's a well known fact among listeners that I like to pick off companies that analysts seem to not care about anymore. 32% of analysts covering Lockheed rated it as a buy or equivalent, and that's well below the 55% average for stocks in the S&P 500. So I think a lot of investors probably waiting for military spending to decrease, and that's why they're not buying into this, because we've got rising budget deficits. But that $120 billion of unused money is going to be pretty good for Lockheed Martin. And we're not going to wake up tomorrow to a unsuspected peace in the world. We're not going to have tomorrow's not going to have we're not going to wake up tomorrow and see Vladimir Putin and say, I don't care about Ukraine anymore, or China say, I don't care about Taiwan. Go ahead, Dave.
So yeah, and that's part of my question I have for you, since you looked into these numbers, right? And I'm familiar with Lockheed Martin. I've briefly looked at some of the earnings reports over the last few years, but you did your detailed research, and I trust you do. Why? How come Ukraine and Israel and all the missiles we're firing from our ships over in the Gulf or in the Mediterranean are not adding more profit than what we should be adding to Lockheed Martin? Because don't they make
Well,
a
I
lot
mean,
of these missiles?
yeah, they do, and we've tripled earnings. So I mean, we are seeing the profit growth here. I just think that people are looking at the military deficit, and they don't think, or not deficit, but the military budget, and they don't think that Lockheed Martin's going to grow over the next couple of years. But I think they keep getting proven wrong. I just think sentiment is bad on this sector right now, and it's weighing on the stock.
Gotcha. Has the stock price gone up equivalent to the earnings?
No, it hasn't. And 27% of Lockheed's income comes from international. So, you got North Korea firing missiles every day over Japan. You've got the Israel Hamas situation. All of these things are, this is stuff that should add to Lockheed's bottom line. I don't want to make light of war here or say, these are great things. Let's all be profit. But, Lockheed Martin is defending us from North Korea and Hamas and so on. And so I think this company, I think, and they're spectacularly ran, in my opinion.
Yeah, I was just looking at a chart of them. They have gone up pretty good over the last 3 years. So, but yeah, based on what you're saying, man, you answer my questions. If I was a listener, I would take you at your word and say, hey, I would buy a few. Are you
I
buying
would
like
buy it.
long term?
Oh
Are you
yeah,
buying
absolutely. I mean,
long term?
if we've got a recession coming up, this is going to be one of the stocks that takes a dump right at the beginning. But yeah, long term, these issues aren't going away anytime soon.
Yeah,
They're not.
yeah. I mean,
I wish
unfortunately,
they
there's
would.
always an issue somewhere,
Right. I wish they would. I wish they would absolutely go. I wish there would be no need for Lockheed Martin. That would be nice, but it's not the case.
except to make planes.
Yeah.
Nice. All right. Cool.
All right. Let's go into the crossover here. So Berkshire Hathaway purchasing 2.6 million shares of Occidental Petroleum stock in the recent days. I think this is just in the past 2 weeks. So now they have got 250.6 million shares. This is 28% interest in Occidental Petroleum. So kind of another counter bet here by Warren Buffett with the oil prices. What are we at? $80 a barrel or something like that for Brent crude.
Yeah, around there. Yep.
7% increase year over year, and that's it. Oil companies, I think they took a hit in the past week, and Berkshire Hathaway thinks they're taking advantage of this. A lot of analysts look. A lot of analysts aren't bullish on oil right now. So Warren's kind of doing the same thing that I normally would if I did anything with commodities.
So you know, I'm glad I'm in the same camp here as Warren Buffett. That I still have my ExxonMobil position, and yes, I took a hit this past week on it, and I have an unrealized loss right now. And if you're listening and you hear the term unrealized, what that means is you're currently down and you bought it, let's say at $100 a share and is at like 90. You're currently down, but you haven't sold it yet, so it's not realized. You actually haven't taken the loss yet. That's what that means when someone says unrealized gain or loss. It'd be the same way if it was you bought it at 100 and went to 110 and you haven't sold it yet. You have an unrealized gain, quote unquote. Anyways, I currently have an unrealized loss in ExxonMobil. Thanks this last week. It's down. So I agree with Warren that the oil companies is a good buy right now. I see a strong future in oil. Currently in the short term, and by short term, 6 to 9 month range.
Yeah.
Is what I mean by short term.
Okay. So they bought the stock at under $60 a share. Berkshire now owns $15 billion worth of Occidental stock. And now they must report any purchases, within 2 business days because they're well over that 10% threshold of owning, a company. So, yeah, I think look, a lot of analysts looking at the oil right now saying 7% year over year increase, and I think it was Brent crude when I was looking at it, but yet copper is up like 20% year over year, 27% year over year. I think a lot of these analysts and a lot of people are looking at this and saying, yeah, the electrification of vehicles is weighing on oil right now, but maybe they're overdoing it. Maybe they're overplaying their hand on that.
So I mean, all right. So really, if that's the argument, all right, that the electrification of vehicles, there has been I'm not all for one for believing every single word that a CEO says, but I've seen the CEO of BP, CEO of ExxonMobil, CEO of Chevron at one time or another on CNBC or Bloomberg because if you watch Bloomberg on Sundays, they have interviews with some of these CEOs. It's good to watch. Anyways, I've seen these interviews with these CEOs, and it's about electrification of vehicles and do they still stand to have a profitable business if every vehicle in the United States becomes electrified? And they said, yeah, we still stand to make billions and billions and billions of dollars. It has an effect, but not as much effect as you believe it does on our business. And that's what they've said on TV. So if that's the reason for the stock going down, then I'm going to buy all day.
I agree. The high for the stock was $69 a share in April. So with Friday's closing price, $59.48, that's well below the closing high that we had in April. And I think Warren's just taking advantage of an undervalued company right now.
Right. And the few times that we've tried to send a airplane in the air with like a hybrid type system, because you can't do electric only right now for a commercial airline jet. But the few times we've sent a commercial airline jet in the air with a hybrid type system, lithium batteries on board, smoke started spilling into the cabin area. There was a smell going on in different flights, and so they grounded them because they couldn't make it work. But I mean, it was made by Boeing, so that could be the problem right there.
Yeah, it absolutely could be. Yeah, I don't. We can go on all day, but we've already talked about our issues with Boeing.
Yeah. Can I take 1 minute here and just trash Boeing again on this show?
Yeah,
I mean, Boeing's probably going to find us, and guys, if Boeing finds us, I'm sorry, but it was worth it. Boeing, they sent that space rocket to space, the largest one ever built, and with live astronauts on board to the space station. But it took them 3 times because they kept having issues with the rocket. After the 3rd time, if I was the astronaut, I was like, hey, a window's not going to fall off while we're flying in space, are we? I would be asking that question. Oh, well.
Yeah. That would be scary. Like, hey, could we not, use maybe Lockheed here, or but what, I'm flying on Boeing. This is scary.
Right. SpaceX is building the bigger one here, and it's going to be available soon. So,
No, that's
all
good.
right, back to
Food
oil.
safety. All right.
So this is a market. I found this on Market Watch, and there's an article. And in the article, the headline reads: "Oil is the best hedge, quote unquote, against geopolitical risk ahead of U.S. election." This is coming from Bank of America. This is what they're saying here. So they're saying in it, prices fell in May, but they're still up for the year. Roughly 15% drops from highs in April, which I felt that in my position in Exxon. And it's definitely going on further here. A lot of people are using oil as a hold and a hedge against, because no matter what happens, you're going to need the oil to move forward in the economy right now, right?
Right.
Um, I'm stalling because my rest of my article just cut off. I love this. This is fabulous, and anyways, I can talk about oil all day long, and I will. I know the article. I know what it kind of. I know what it said. Luckily, woo, luckily, I do my research on oil every week. What they're thinking is we're not going to have a recession because they feel like everything's pointing to the economy is strong. You had a jobs number come out that was strong. You see wages rising up. That's strong. I'm about to get into this into my next article as well. But you see all these strong economic numbers, so that means the U.S. is still consuming oil. The slowdown that you saw this year is in China, is where the real slowdown was. China is starting to maybe begin to turn the corner over there with their slowdown. But as I reported this earlier this year, unless they're making more and more and more jobs, they don't have enough jobs for the amount of people they have graduating. I covered that earlier this year. So they still have those hard economic conditions to turn around in China. However, in Europe, you're seeing a turnaround. You're seeing the ECB go ahead and start cutting rates. You saw the Bank of England go ahead and cut rates recently as well. That's two major banks cutting rates. So you're seeing economies being able to turn around. And so that's why people are believing that oil, okay, if the economies are getting better, oil should be in demand. We shouldn't see a drop in oil. We're going to have a good second half of the year. That's the basis of the article. I'm summarizing because, again, I lost the article here. So much for live podcasting, right, Brandon? But
Right.
thoughts on that aspect of oil.
One of the reasons why I've never gotten into oil is because it's so heavily manipulated by OPEC, for example, and by other governments. and and the result of that is that you don't have the regular market kind of fluctuations that you would normally see had oil been just left to the free market. um, it's not as predictable as a result. For me to say this is what OPEC is going to say next week, this is what all those countries are going to agree upon. I do think that OPEC has something to worry about with rising U.S. oil coming into the market. Um, I do think they have to worry about that. I think that's probably more on their mind than the electrification of vehicles. I like the new competition that's being introduced into the market from us. I like that stuff, but I just never really touched it because it's just been even as somebody who looks at the macro economy and knows a little bit about what they're talking about, like I do, it's still something that does not fall into the index card of macroeconomic theory because you've got people who are dictating it, right?
Well, yeah,
So,
but I mean, go ahead. Sorry.
yeah, like COVID, we all knew what was going to happen to oil. We know it was going to go down in price. Recessions, we all know that weighs on it. But these arbitrary cuts and oil stock and increases of it, increase of production of oil, those are things that I just can't predict, and that makes me stay away from oil as a result. Um, my opinion of what Warren Buffett just did in Occidental, I've been preaching, I think we're going into a recession for years right now, but it seems to me like Warren Buffett's making a bet on the US economy for the next 2 to 3 years that we won't go into it.
Yeah. So the data. I mean, again, I go back and forth on recession, not recession, bear, bull, and I try to go off the data, but makes me seem like I'm wishy washy.
Well, that's
A
not
couple,
fair because like the data has been so mixed,
yeah,
right?
yeah. So a couple things here. OPEC, and I reported this on the last podcast. If you listen to last week's, they went ahead and they extended their cuts. They said they were going to extend their cuts, and that's at least set for the next 6 months, right? 6 to 9 months extended cuts. We know that. The U.S. went ahead and released 1 billion barrels of oil out of the reserve. The current reserve is sitting at it dropped below a 20-day supply. So that means if we don't pump any more oil out whatsoever and we just use up the reserve, it's going to last us 20 days as a nation. It's meant to be over 30. So that's why the other nations aren't concerned about the U.S. Using the reserves, because we're meant to have over a 30-day supply and we don't. And that's a concern there right away. So that should eliminate those kind of questions in people's minds when they are considering oil. I think that we're going to have to pump, or we're going to have to be relying upon OPEC for a while to go. And so they control the price. And if they want the price to stay above 80, which they do, in order to make their demands, their needs paid for, I mean, the price is going to stay above 80, which is, that's going to make Exxon a little bit more money, which is why I have a stake in Exxon.
Yeah, that makes sense.
So,
Yeah.
all right. So moving on from oil, let's talk about some of these economic numbers. I mentioned, Brandon, that I was going to go over these, and we were going to discuss possible impacts, if you will, on the economy and stocks and investments. So this one is I'm just going to, because I like this article that I'm going to quote from, because they give all the numbers in it. And that's what I like. An article that just releases facts and data. And this one is on Reuters. It's from, the headline reads, U.S. job gains surge past expectations. Wage growth quickens, by Lindsay Dunsmuir. This was 2 days ago on June 7th, right? So the U.S. economy created more jobs than expected in May, and annual wage growth accelerated. One of the highlights from this, though, was the unemployment rate ticked up to 4% from 3.9% in April. So one of the first times in a while it's been 4% or more for an unemployment rate. However, because it came, the job creation came in still higher, that means that the Fed is saying, hey, we don't need to cut rates because we see that the economy is strong. We don't need to cut rates until the economy shows some signs of weakening. So that took the chance of a September rate cut from 70% to down to 53%. And even took a chance of any rate cuts this year down to 50% overall. So now it's a toss-up of whether or not there'll be a rate cut at all this year. And it's because of the quote-unquote stronger economy. Wages are growing, jobs are growing, and so they're saying, hey, we don't need to cut rates. Let's continue to push for 2% inflation rate. And that's what they believe the Fed is doing, even though the Fed hasn't come out and said that. That's what everybody believes based off these numbers. And if you look at a chart of the numbers over the last 3 years of job numbers, we're pretty flat. 2023 and 2024, you have ups and downs, but that if you draw a line in the middle of it all, we're flat. There's no growth in there or decline. It's been pretty flat of growth there. And surprises. I mean, we've had some down times, but it's pretty flat as well. So the good news is that by percentages, wages are going up higher than inflation right now. So it's biting into all the destruction caused by the high inflation a couple of years ago. We're slowly chipping away at that. We are still not back to where we were at that point. I don't know if we'll ever get back. But currently, wages are going up a higher rate than inflation, which is good news for the average individual out there, which means that's good news for the economy. So that's some of the numbers we're looking at. I could go into here and break down the numbers of this many healthcare sector jobs, and it was 68,000 healthcare sector jobs, 42,000 government jobs, professional business services, 32,000 workers there. We could go in and break it all down. I don't really, I mean, it's just typical numbers you see every month. I'm not really going to go into that. But the average hourly earnings rose 0.4%, and wages increased 4.1% in the 12 months following May. It's an upward revised number from 4% the month before. So that's what I'm talking about. Wages are rising at 4% versus the inflation is sitting right around 3%, and they're trying to get down to 2% inflation as it is. So good for the economy, which is why we don't see a rate cut come in. So that means that, is the housing market going to be affected by rates higher for longer? Is this going to continue to drag down the housing market? Is this going to continue to affect those numbers there? And is there going to be a problem if this continues on, or are people just going to adjust to it? Because rates were like this for years, and we still had a housing market. So are people just going to accept that this is the way it is? I'm going to let you get a word in before I continue, Brandon. Go ahead.
Okay, it's frustrating because the fact of the matter is that 9 out of 10, according to polls, 9 out of 10 people say that the housing market right now is bad for buyers. Yet everybody keeps buying houses. And I don't understand that. Where's the disconnect? Do you think it's a bad market for buyers? It's a bad time to buy, yet I've got people down my street that list their house for, $30,000, $40,000 more than what it would have pre-COVID, and it within a day it's sold. It's insane to me. It's wild why that's happening. Yet everybody says it's a bad buyer's market, but there seems to be some sort of disconnect there. The other thing that I want to say too is I think the Fed focuses way too much on wages. Way too much. Listen. I think that wages. It's a symptom of what could possibly be higher inflation for longer. It's a symptom. Or a cause. It's really a cause of what it could be. But if we're going to make the case that look, we just had wages go higher than inflation, but that's like what, the first time in years. That's a unicorn number that we rarely ever see. It's wages are catching up to inflation, in my opinion. If we're going to make that argument, then it really doesn't matter that wage growth is going up right now, as long as it doesn't surpass what inflation has done for the past 4 years. And even if it does a little bit, that's still, kind of good news in my opinion. Really, what the Federal Reserve should be looking at is M1 and M2 money supply. Specifically, how much of that money is still left from the bailouts that we had from COVID and all those stimulus checks, specifically that, but then also the increased government spending that is hitting the economy. All the increased government spending, all that stuff is having a way more outsized effect on inflation than any wage growth is. Right? So, and inflation is a part of wage growth. I realize they go hand in hand. I get that. But if you're looking at wage growth and saying, well, we need to keep rates higher for longer, really the reason that you need to keep rates higher for longer is uncontrolled government spending. That's your big problem. That's your
Yeah,
big problem. I want to know the growth in M1 and M2 money supply. That's my focus right now, more than wage growth.
Yeah, all the big World Bank leaders, ECB, World Bank, IMF, International Monetary Fund, they all say the U.S. needs to get a hold of their government spending. Everybody does. Everybody outside the U.S. is criticizing the U.S. on the government spending.
But also, pot's calling the kettle black here because Europe needs to do the same thing.
Yeah, but it's easy to criticize when it's not your government and it's not your agency, so it's a little easier for them.
Hey, our government is doing what you've been doing for 20 years. That's what's happening. We're following you. So criticize the United States on that all you want. But pot's calling the kettle black on that's all of the major, at least you call them Western governments. I guess that's the right term for them now. But all of the major Western governments, and that includes Asia, like Japan and Korea too. But all of them, everybody, get your spending under control. That's why global inflation is so wild.
Yes. So I want to get into some of these things. Why did if we had a positive month of data for job creation, why did unemployment tick up? Well, let me read a couple paragraphs from this article here, and it's near the end of the article, and I'm just going to read verbatim here for two paragraphs, real quick. Friday's data showed the labor force participation rate fell to 62.5% in May from 62.7% in April, reversing this year's progress and driven by fewer workers in the 20 to 24 age range. But participation by the prime age population, defined by 25 to 54, rose to its highest level in 22 years. Some economists question the divergence between the strong job gains and the rise in the unemployment rate. Basically they're saying, how is these two things happening at the same time? Well, the two figures are derived from separate surveys within the report. The employment measure contained in the household surveys fallen in 5 of the last 8 months. That survey showed 250,000 individuals left the labor force altogether last month. So that's
Wow.
why, yeah, that's why you see the unemployment tick higher, but yet we're creating jobs. People are just no longer working. They have left the labor force.
And that's been something that's been a controversy when it comes to the unemployment number for years now, because you give somebody so much time without being in the labor force, then all of a sudden they're not counted in the unemployment numbers. People who are not actively looking or searching for jobs, maybe they gave up, maybe they're lazy, I don't know what it is, but those people aren't counted.
Right? I wouldn't call them lazy. Maybe they got gigs, or maybe they're doing freelance, and they're
Some
just
are.
not reporting. They're not reporting because some of those gigs and freelances don't report to labor, and so that's a true thing. So you see that happening as well,
Yeah, that's true, but some are lazy.
right? And in
Technically,
my
though,
final
then
thought, I'm going to go into something else that is another number that doesn't report into a bigger number. Um, and it's weird how these things work. But anyways, back here. So we talked about government spending here, right? I want to talk about, and we've covered this on the show, of the actual balance sheet of the federal government. If you don't know what that is, the balance sheet is the federal government buys its own bonds, which is hilarious to me. So they create a bond to get money, and then they buy it with their own money, and then they pay themselves interest, which is it just blows my mind that this is a real thing, but it is. So they own bonds, and then they own mortgages. They buy up mortgages every single month, right? So this is what the Federal Reserve releases a balance sheet because they got to report to the people, which is us, the citizens of this nation, what they're doing with the money has to be publicly available. So the Federal Reserve balance sheet, it shows
yeah,
what
but
the
it's never audited.
say what.
It's never audited. So yeah,
That's
they
true. It's
report
never
it, but they
audited. Yeah.
never check into it.
So I said, all right, so we're all talking about, federal government spending here and how it's affecting the economy and so on and so forth. And that all these foreign leaders are telling us that we need to quit spending so much. Well, what have we been spending, and where's our balance sheet been at for, some time now? So I have a chart pulled up in front of me, and it goes all the way back to pre 2008 to July of 2007, and then all the way forward to today. And it's interesting because you see back in July of 2007, the federal balance sheet was at 864 billion. There was no trillion listed. It was 864 billion, and that was it in 2007. So then, 2008 and into 2007, the financial crisis happens. All of a sudden, we jump up to 2 trillion 136 billion. Because we had to raise some money to bail out everybody else. So $2 trillion goes on up. It continues an incline all the way up until about 2014. It peaks at 4 trillion 486 billion. And then it stays pretty flat. And then it comes down to a low. The low happens in September of 2019. That's when we get down to 3,761,000,000,000. So we actually start making progress in bringing down the Fed balance sheet. And then, of course, we know what happens in 2020. In 2020, COVID happens, and the federal government went ahead and just enacted all these bills to go ahead and raise money. So in 1 year's time, we went from 3,764,000,000,000, and let me get it right, to July, all the way up to $7 trillion. So we doubled it in 1 year, our balance sheet, in order to have all these bills that we passed. And then from that point on, it was just a steady rise up all the way. And we peaked in 2022. We started to come back down. And then in February 2023, earlier this year, we started spending again. And then it peaked in March of 2023 this year. And now it has finally started coming down. So besides the COVID bills, what happened was we had started to go ahead and do quantitative tightening instead of easing in. And in 2018, we started doing that, and it started tightening, and we started bringing it back down. But then COVID hit, we enacted all these bills to pay for all these things. And when you look at the Fed balance sheet, it shows that. It shows that the government's spending money they don't have in order to pay for all these things. And you can see the balance sheet basically is like a credit card statement saying this is how much you owe. And so that's how much we owe still to ourselves, or to other bondholders, whether other countries hold bond. I know there's a Japanese pension fund that holds a lot of bonds. But this is money we owe, and it's going to affect us if we don't continue to bring it down, which right now we're on the path to bring it down if we continue with quantitative tightening. But last month they announced they might pause that because they were concerned about a recession. It was funny to me because I'm like, we don't need to pause that. We need to keep quantitative tightening going. Brandon, thoughts?
Yeah, and then so there's your inflation. There it is, and then the government spending. And listening to it, you may just listen to it in passing, but it should really make you mad, because that's why, like when the analysts get on and say, "Oh, the fast food employees, they're making $18 an hour, and that's why your Happy Meals are $15 or whatever," you're looking at the causation of or not the cause of inflation, but a symptom of inflation. The reason why these things are happening is because of what Dave was just talking about with the Federal Reserve and government spending that is out of control. That's what's causing inflation. That's why your Happy Meals are $15 or whatever. That's why the OSB boards I just bought for my garage were $500, the most boring $500 I've ever spent in my freaking life. That's why those costs are so high. And they're robbing you. We're getting robbed. This is theft indirectly, but right out of our pocketbooks.
So if inflation is still high and we still owe $7 trillion, again, I go back to a podcast that we talked about earlier. You look for companies that have that they're able to eat the inflation and still make a profit. So you want companies with high profit margins. Right now, still 2 years later from that podcast when Brandon was pointing this out and laying it out in detail, I believe that still to be true because we still have these issues where if I give the example of Tesla's had to cut costs. Other car companies such as Ford just quit making electric vehicles because they couldn't make it. They couldn't do it and make a profit. At some point, they just said, we're losing so much money on this, it's not worth it. But Tesla's still profitable. So you look for companies that are able to cut those prices but still be profitable.
Yep.
And that's what I look for in times like this. Still, 2 years later after the peak inflation, Brandon, we're still talking about this, but this is still an issue that we need to talk about, and you still need to look for those companies that are able to maintain competitiveness by cutting prices to consumer but still being profitable. And Target wasn't. Target lost a third of its value during this time. You said that you covered it, but Walmart was able to. Walmart has been able to.
I remember about 20 years ago being surprised and upset that the U.S. government was running a $6 billion deficit. And what a wild-eyed, naive youngster I was.
Wow. Yeah. That's crazy. But yeah. All right, so let's move in. I'm gonna let you guys take that information in, and if you have more detailed questions about how to use that information, like do you buy U.S. Treasuries? You know, the government's they're paying them off, they're getting rid of them, they're unwind. They should be quantitative tightening still, month by month, each month, getting rid of more of those off the balance sheet. But so, do you buy them? Do you hold them? Do you not hold them? I know a lot of ETFs, mutual funds, are holding them. A lot of companies are using them as collateral against derivatives that they're playing in. That's one use for U.S. Treasuries. So, what do you do with this information? DM us, ask us,
The
reach out to
thing,
Brandon on StockTwits and DM him.
the treasuries they're still safe in my opinion. I think they're still 100% safe, and not for the right reasons. It's because oil's traded in the US dollar, and that's protected by the largest and best military in the world in the United States, which I hate bringing it to that, but that's the fact of the matter is the U.S. Treasuries are going to be fine. The problem just comes back to inflation is wreaking havoc on the average American pocketbook, and it's because of government spending, and it's because of and wanting them to monetary supply increasing. And by the way, even if the Federal Reserve does tighten, what does it matter so much if the U.S. government doesn't pull the purse strings back a little bit? I don't know that it matters that much.
There you go. Brandon, final thoughts.
All right, Dave, you started to argue with me on this one a little bit, but Waste Management's acquiring Stericycle. This is going to be a $7.2 billion deal. Um, This is going to be around $62 per share in cash. That's about a 5% premium. You know what I do with these when there's a 5% premium. This is closing in the fourth quarter of 2024. So this isn't going to be like the Activision Microsoft deal where there's, all kinds of court battles and stretched out over the next 2 years. This is going to be by the end of the year, 2024. I don't think this is going to get blocked. I mean, I could be wrong, but I think it's a slam dunk. 5%.
I think you are wrong. There is
Really?
not enough major waste management companies here. You could make the argument there's a lot of regional, local ones, but national brands, there are only two that come to mind. Waste Management, one of them. And bringing up Stericycle could be creating a huge conglomerate. Also, I don't see it as a positive for waste management. I see it as they got money and they don't know how to properly use it, so they're just buying companies in order to maintain growth.
I mean, I'm not buying Waste Management. I'm buying Stericycle here for the 5% increase. And yes, by the way, you are correct if the government followed those rules, but they don't. So what they only do is they attack the companies that it's politically profitable for them to attack, like Google or Microsoft or Meta. Waste Management, nobody talks about them. Most people probably don't even know who they are.
Well, the Chinchilla Picking podcast just talked about it, so
They
there
do.
you go.
We do, but it's not politically profitable or politically advantageous for Nancy Pelosi to go and block this deal. So she
Gotcha.
probably.
Gotcha. Cool. My final thought. I have a two-headed final thought here. Number one. So this is a stat that is not always reported in household debt or credit card debt or any kind of debt in out there in our reports that we look at. Like the when we say, hey, what's household debt currently at? How many people owe money on credit cards? You can find that information out there. It's reported monthly, weekly in some cases, and you can find the information. However, there's things like Affirm and Kraken that, I think it's Kraken. I don't know. I might be saying it wrong. Um, Big companies out there that do these, payment plans for purchases. You can't afford that really nice mongoose jacket, so Affirm will let you make payments for 6 months on it, right? Well, those companies aren't always reporting all these things because they don't legally have to.
I'm
So it's not.
surprised. Hold on. I'm surprised Robinhood's not allowing people to use Affirm to buy GameStop.
That is great. I'm going to go on the GameStop stock twits and post that. Anyways, Yeah, so they're not listing these as they're not listing it as household debt or people's debt, and it's not even showing up sometimes on credit reports that they owe this money. So when we see that household debt's at all time high and that households have so much debt per income and that it's stressing them, it's not even being included the money they owe to a firm. It's not even being included the money they have to these, hey, buy now pay payment plan services, and so that could have a higher stress as well, and especially among the lower income demographics, which makes you concerned. Then now that you know that fact, how good is the subprime market? I know Goldman Sachs was trying to pull out of the Apple Card because it turned out to be a loss for them. I know the subprime market's been hurting, and now this other fact comes into play that hey, they're not always reporting how much they owe because they don't have to. They don't have to legally every single time report that hey, Joe over here has like $1,000 in debt owed to us. Crazy that the numbers are all time high, not including those numbers, Brandon. Not including those numbers. When over 7% of all holiday purchases were purchased using those plans. So that means they probably are still paying on it today, right now, for those holiday purchases, but it's not included in household debt.
Crazy.
All right. So the last little piece here I want to talk about is a new ETF that just came out. And of course, everything just breaks down. It's good. It's okay though, because I posted it in our group chat. A new ETF that just came out, and the ETF is ETHU. ETHU. It's a new Ethereum ETF. They're going to do this pretty much the same setup as Coney. Coney has a setup of they hold U.S. Treasuries as collateral for trade-in premiums on derivatives such as options on Coinbase and other Bitcoin related. That's why it's called Coney, CONY. This one is Ethereum. They're doing on Ethereum. They're doing options on Ethereum futures. So they're going to do spreads, and then most likely they will hold treasuries as well as collateral on that. So where all the U.S. Treasuries going, they're going to all these highly income yielding dividend paying ETFs because they got to buy them all up to hold them as collateral against their derivative plays. And the law says that if you're going to set up an ETF with that, I believe, and I may be quoting this wrong. So if I'm saying this wrong, someone please DM us and correct me on this. But I believe the law says that if you set it up as an income ETF, that every month you got to pay out. I believe it's up to 90% of the money that you profit that you made that month out to dividends to investors, because you set it up that way as an income ETF. And I believe that is the case. And so that's why some of these are paying out very nice dividends. I know I got my dividend payment on Coney. I know a lot of other people did. I know, I've told a lot of people about Coney. We all got our dividend payments on Friday. It was a great Friday payday for all of us. We enjoyed it. So there you go. That's my final thought. All right. So as always, we hope we have been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.